Yo, what's up, you guys? So I want to go ahead and jump on this video on this topic because I think it's a relevant one at this juncture, at this time. Today is the 1st of October. It's going to be the first video for this month. And thus, we are finding ourselves with a nice little pump for crypto, but then we find ourselves, still not continuing that move, right? Bitcoin gets off these local lows from, the September time, and then we are trudging up. We hit about 66K the other day. Then we kind of came back down 63, and people are already like fearful. Like, oh no, here we go back down to the bottom of the channel that we've kind of been in. Is there Uptober? Is there all these other crypto questions? But we always have to understand that there are larger money aspects and things that we need to be looking at versus just price for crypto, especially Bitcoin or any other thing that is basically dependent on liquidity flows and how much money is in the system to be able to be used to even go to assets in general. Anyway, so today, what I want to petition and try to craft together the idea of understanding how do we substantiate, how do we get a qualitative analysis of what the United States government does with the money supply on a yearly basis. Like, how do they manage their books? Because based upon how they do on an individual year, that shows or gives us a preview of what markets will be looking like here moving forward, and then also in the midterm and the long term. So with that being said, grab your seatbelt. This is going to be a Federal Reserve / Treasury analysis on how they deal with our budget here in the United States. Thus, helps us lean into understanding the money supply and liquidity just that much more. So this is an amazing website that I found, and it's a beautiful thing that kind of makes things plain. And this is going to be the fiscal data website. It's literally treasury.gov. I don't know if y'all can see that. It says treasury.gov. So very, very, I guess you can say, transparent in terms of actually looking at the actual numbers. So the first thing that we need to look at is how much money the government has spent. So if we look at this, U.S. government has spent $6.9 trillion in the fiscal year 2024 to basically say they're going to ensure the well-being of the people here in the U.S. It ain't about that. So basically, this is like, hey, what is the inflow money that they got? Like, how much they making? This is basically a large percentage to taxation. Maybe there's tariffs from other countries. But as you can see, we're taking in money. So compared to the fiscal year, we're talking about during the same time period from 2023, we're doing a little bit better. So this is something key to think about. But, this is very interesting because what do we look at? How do we collect this tax money here in the U.S.? A lot of it is going to be that Social Security, Medicare, right? Health, all that kind of stuff. But then how do we spend it? Right? Because they got to collect it to spend. That's the key. They're collecting money from all of us that are working in this economy to spend it back for other purposes. Social Security, Medicare, net interest. This one is what we got to understand. This net interest, this money that the government has borrowed, they carry an interest on it. They've got to pay interest on it. We need to discuss, okay, well, what is that interest rate? The fluctuations in that interest rate that they have to pay back. Some of it is private debt. Some of it is public debt. Some of it is, they've got to pay back to other countries. All these things, it's going to have a period of time that we need to look at. Okay, well, when they're refinancing, because they don't pay this debt back. Because if they did, then guess what? The national debt would go lower. They have to refinance the debt to where they can afford to pay that amount off, plus the interest, and just kick the can down the road. This is how it works. So 13 of the tax dollars go to that. 13%. More than We're talking about veterans benefits more than they're trying to spend money on educating our kids, training employments, which we need, more than transportation for everybody to get to and from the work that they have to go to, or else they can't live because they're going to tax a good portion of it out of existence. So, they're taxing our hard work. They don't even want to help us out with transportation. Come on now. So we can see this site is a beautiful learning tool. And so you can even track through the years, the fiscal year, the total amount that's spent, but then also the GDP. We're going to get into that here in a minute because we need to understand the levers that matter most when it comes to liquidity. And this is not just the whole world. We're going to put a spotlight on the US because they matter the most when it comes to these money moves. But understand that when the United States decides to go down on its interest rate, it's for a reason, and why money printing can't start in other countries until that happens. If you notice, China did not print any money until they were sure that the United States is going to go down interest rates. So this side is beautiful. Now let's jump over. So we understand that where they've already spent, and the full year ain't even over, just about, but 6 trillion. Now, that's revenue. Or that's spending, excuse me. The revenue is just about 4.3. So once again, they get this from individual taxes, corporate taxes, Social Security, thus 4.3 trillion that they've collected. As you can see, the revenue was pretty good, it looked like, for them in 2022, 2023, not so much. Think about it. From 2020 to 2022, there was a lot of money creation. Think about it. The more money creation, the more taxes that they can take back. So, something that we must adhere to. So the interesting thing is, yes, the revenue is pretty similar most years, just about 4 trillion. Then it jumps up in 2020 to 4.5 to 5. Last year, 4.4. And it looks like this year we're already kind of beating that. So we have those two factors. Now we got to think about, okay, well, what's the deficit? What's the difference between the two? Basically, how much the U.S. has spent on all these things versus how much money that they've actually collected. The deficit just for this year is 1.8 trillion, so almost 1.9 trillion. Let's just call it $2 trillion that they've been irresponsible this year in spending. So just like anybody else, where you're like, man, you're irresponsibly spending what you have. Like the fact that they could spend more than they have is crazy, right? But then it's like, okay, yeah, we'll just borrow from other places, borrow from their own public, pay them back a treasury yield for these treasuries that we issue. They can just create treasuries. That's like, it's the craziest thing if you think about it. They just create these treasuries. Hey, we create these treasuries. Y'all buy them so we can keep and I get it. They want to keep the economy going. All these benefits, like it comes back down to like, they got to keep this going because you can't promise people like, so for example, you can't promise people that you've been taxing for their whole life that, hey, you're going to get a little something back from us when y'all turn 65, and then be like, nope. Think about all the people in office that are older. They're like, yeah, these are my friends. I can't be the person that takes this away from them or a percentage of this away. Because why? They can't, because the purchasing power of these dollars that they give, just in general, if they gave less of it, it'd make it even harder for them, and it's already hard, even if they give them a check for $3,000 a month. So this is something that's very important. We've got to understand that they're in a conundrum. So once again, going back to the deficit, the deficit is 20% more than what it was last year, okay, during this time period. And we'll look at the end of the year and kind of see, but we can get an idea. Most of the year is basically almost over. So there's more of a deficit this year than last year. Also, there's going to be more, I guess you can say, interest that accrues compared to last year. So at some point in the future, what can we expect? Because there's only a couple ways to deal with deficits. Either you need to tax more, or you need to accrue more debts and roll them over. And so let's actually go here. Now, let's get into the data set details for the average interest rate change on the national debt. Now we're getting into some sauce. So this is the hard part, where you talk about these treasury bills and you're starting to see some numbers that are like, oh, that's a lot higher. Like we just look at the year 2024, you see some of these marketable treasury bills, the average interest rate that they have to carry is 5.5%. Oof. That means more money needs to be created versus if they were only like 2%. Because if you just do the calculation, 5.5% or 5% on whatever number is more than 2%. So that's that much more money that they got to create to cover it, to pay whoever back. So that's very interesting. Let's actually, because what's very nice to hopefully see, if we can just kind of pop in some other years so we can get a good idea of how different time was. Let's see. Let's go to 2018 or something. 2017. 2017, October. Let's go 2019 or something. Let's just. So, same thing. What we need to understand is the treasury bills, the notes, and the bonds. Right? During this window, this gap, is they're like, all right, cool. If we need to create more treasuries, they're going to basically pay out about 2% on them. All right, cool. The bond's a little bit better, 3.8. But there's a structural difference because think about it, on a larger debt amount, once again, if we look at the actual debt, it just keeps going higher. On a larger number, they're paying a larger percent. That means trouble faster. So they need to potentially unwind that trouble, aka go down the interest rates, to help out this average rate through time. I'm hoping this is making sense. It makes a lot of sense to me. Okay. So now we must understand that it's not just, okay, well, we just track how much total debt that we have. And let's go to the debt clock. Because it's like, okay, well, how do assets go up? Like, what's going to be the thing that pushes them up? It's going to be, let's see here. It's going to be another part of the ratio that we must assess. So yeah, the U.S. debt, we're looking at 35 trillion. Now, and we got all the stuff, the revenues, all that jazz. So the other side of what we must look at is not just the debt. Now we must come down to this part here, where we're talking about U.S. debt to GDP. This ratio is going to tell us in the near term and also the midterm on how we can probably experience the outstripping of money that's being borrowed and created compared to the actual productivity that the United States has. That's the ratio that we must learn to look at. And I'm going to show it to you guys. So this is crazy. I mean, as of now, this is just showing that the game is getting harder and harder and harder. Even if you want to look at every 20 years, man, the game's getting harder. I mean, from the 80s, we're in a good spot. It's like, okay, basically, we're collecting and we're producing more than what our debt is. 2020, still not too bad. 2024, we're over our heads. So they've got to keep playing this back and forth game with the interest rates and debt creation to pay off what they borrowed. Because this is serious. Japan is in the same type of thing. U.S. gross domestic product is the other part of the equation. 28 trillion, right? 35. Now, we need to just not understand the total. Okay, we can see the total, but we also need to extrapolate year upon year change for the ratio. So, once again, this information is right ahead of us. Let's jump over. So, what you guys need to understand and do, and if you understand that stocks look the same, so this is a proxy to say, okay, all this excess money over our productivity, that's the actual liquidity that gets spent in assets. So to make it make sense, when this thing going up, assets doing fine and dandy. Therefore, thereafter, the next 12, 24 months, this is what we got to understand. So let's look at this from a couple different angles. This is going to be the federal debt, total public debt, as a percentage of gross domestic product. So as you can see, we're in over our heads, right? 132 at its worst percent, and they had to try to dial that back. But as you can see, we're back at 120%. So key thing is when this is going up, money printer about to go. It's going down, as you can see. We slow down. Not saying that there's not due money creation. It may slow down, or we say, okay, well, what helps us go down or sideways and more is that the actual treasury, they don't hold as many assets, and the Fed runs off their balance sheet. Currently, they're doing that about $95 billion a month. So we're like, okay, now let's dive a little bit deeper. It's like, okay, well, let's look at the percentage change. Boom. Change percent of GDP. And this is what helps us. So when we see this, a whole lot of money borrowed, aka debt creation, because either they're rolling stuff over currently or they're issuing a whole bunch of treasuries so they can get money in to spur the economy. The money's going to end up somewhere. So if you notice, the volatility on this is pretty muted. Yes, they played the game back and forth for years before, but here in 2008, if you notice the volatility of how much money gets created on a particular year or two, and then how much money gets kind of fluctuated back, the volatility has been crazy. COVID, there's like, super influx of new liquidity, new money, and then tamed it back. When this is quarterly based. But yeah, boom, big influx on this quarter. The volatility is increasing. So how do we know? Like on a quarter basis, like, okay, compared to what we're spending, and this also leads to inflation. But understand, inflation, if you have assets, is actually a good thing. Because the money supply is being suppleted. That means whatever you hold is going to be inflated in price, not necessarily value. Price and value are not the same thing, but in price, if you have something, I guess that's valuable to you because it goes up in price. So we want to see this going up. For example, we had a little bit of impulse where we're negative, we go positive in Q1 2023, going from negative to positive. If you recognize that was the lows for Bitcoin. Then we came up. In 2024, we've had some influx. Yes, price can go up. Why? Because of other factors. For example, if you say, hey, we opened up Bitcoin ETFs, right? Q1 of 2024, you don't necessarily need this going up for price to go up short term, but as you can see, it's not sustaining. We need to understand when we have big influx, large influx, that's going to sustain for a real full bull run. This is why we experience like these, why are other things going up but crypto isn't? This is because we're looking at crypto as the most excess liquidity goes into crypto, not the forefront because it's going to go on first. Stock market, real estate, crypto follows. Let me see if I can jump back on this. But if we understand this phenomena, which is just pure data and information, we can see that the more that they, once again, go ahead and keep outstripping the actual income that they get with spending, then yeah, the purchasing power of all these dollars are doing this. So the key is not to hold dollars, but the assets that'll keep getting inflated that go along with the misuse of spending and collection for the U.S. government. So how can we get an idea? We can use treasury yields in the treasury market to help us understand. So basically, once again, the United States government issues more treasuries when they're trying to start more of that engine being, saying, hey, we want to go ahead and spur this economy. So we need to issue these treasuries so we can basically, get more debt. People buy these treasuries that we create out of thin air. We take it as debt and then we pay it back plus an interest. So the treasury market is this is the 10-year yield. You're going to sniff it out. So what we can see is this is going to be a proxy and that which we can understand on how the treasury market is seeing economic concern or non-concern, I guess you can say. So the periods and points where we see the yield go up, for treasuries market is saying, okay, yeah, we see some potential concern. As you can see, we've seen that since, COVID. And it's been on this trend up, but this is not the overall trend. This is a counter trend to the overall trend, which through time, there's just going to keep being more debt creation than actual productivity. This is what this chart means. So basically how you can extrapolate this chart since 1981 is saying, yeah, assets going up. When the yield goes up, there's some concern. When the yields go down, less party. S&P 500. I'm gonna put this on the charts. Oof, let me redo that because that condensed down too much. Let's do this. Oh, okay, yeah. SPX. Now, with that being said, if you look at the volatility on the S&P 500, it's going up. It's allowed to just keep growing because of this phenomena of extra money in the system, which finds a home. Now, once again, this is not the only factor that contributes to the S&P 500 because there's other countries that rather have U.S. assets compared to their own currency, aka China, aka all these other places. So China printing money is also going to lean into this price chart going up too now. But the thing is, this is perpetually going lower and this is perpetually going higher. That's now all the small fluctuations. This is not what we're focusing on. We're looking at big picture in this scenario here. Okay. Let me make sure that this is in log. Okay. There we go. As you know, this can perpetually go higher. And what helps us understand that phenomena is this keep going lower. Yes, there's times where both can go up at the same time. It's not what I'm saying. Looking at the overall trend, not what's happening over a span of a year, year and a half, because these blips, for example, oh, it's going up. So what does that mean? The bond yields are going up. So that means people aren't buying them? Just look at these, like these little blips. Or let me see if I can highlight them a little bit better. You don't need to get so fearful of like, oh no, what's happening here? Or even this one here. Oh no. Yes, it may show some market concern. But as you can see, price can still go up during that time. It could also go down during that time. This is not what I'm reading. What I'm reading is the overall factors. It's saying that they got to keep making treasuries. That's the key. More than what they currently have. And then they buy them back sometimes, but they're issuing. And the factor is they're issuing the treasury at the higher yield compared to conversely before that. So once again, the thought idea of saying, if you have a treasury that you issue to whoever at a higher yield and you don't have enough income to actually pay that yield to whoever you've lent that treasury to, how are you going to pay it? You're going to pay by creating new money, and simply because the interest is higher, you have to create more money versus if it was a lower interest rate. That's the key, you guys. So understand, oh, they got to, and compared to this shorter term, they got to, this is just saying, oh yeah, just more money creation compared to, time period like when it's going down. And they create money during that time too. So this is leaning into saying like, yeah, we could really, really, really see some big liquidity coming. And understand that this happens because the average debts that, when they're issuing them, it's not just right away. Oh, the next day. This is me looking broader scheme over the next 4 to 6 years, because the average maturity on whatever yields, you're going to get some longer term stuff. You're going to get some extremely short term stuff. But if you want to look at it, they have to do this thing once a year, right? And there's sometimes, like, as far as the whole refinance aspect of it, right? There's times when they have to refinance more. There's times when they have to refinance less. We're going in a time where they have to refinance more because there's a higher percentage here within the next 4 to 6 years compared to the previous 4 to 6 years. And how do we know? How do we verify that? We can look at interest rate, but we can also just look at the actual treasury yields and see, oh yeah, like 4 to 6 years from this. So from 2020, this start going up, right? Oh, this is them. Oh snap, we got to create more money later. 2021, yep, we got to create more money later. 2022, oh snap, we got to create more money later. Oh snap, 2024, it's later. That's how you read that. In 2024, 2025, 2026. So they can't keep doing that to themselves, right? Basically saying, all right, let's go ahead. We got to start U.S. interest rates. We got to go ahead and start going down these rates, y'all. They can't keep doing that to themselves. So let's kind of hide this for the moment. Think about it. Think about if you're trying to manage a budget. They're like, yep, we've held this to get this inflation down, and we see that they got a mandate of saying, okay, we got pretty decent employment. Inflation ain't so crazy. All right, cool. We've done our job. Let's go ahead and take it back down. They got to protect their butt. Some people are trying to get elected still. So they probably won't be because of this experience. And this is the boom and bust that we've experienced with all regimes. Democrat, Republic, back and forth. Don't matter. It's more money creation with all of these presidents. So we've got to see that, yeah, they're going to go ahead and take this thing down expeditiously through time. Because they don't want to keep, because if they keep this up or if they keep this going higher, what happens? The ratio just goes crazy. And we know what happens when this ratio gets to 180 something percent, like Japan got there. And they're perpetually in a state of like, yo, they ain't sovereign. They have to depend on us. They got to depend on other countries so much because they're net exporters. They don't create nothing. But they got a lot of issues because they borrowed too much at a certain point in time. And their market sucks because of it. So this is the key. So to wind this up, I'll trek on over to Bitcoin. And we'll look at total 3 briefly. Bitcoin. People are like, oh no, oh my gosh, oh my gosh, oh my gosh. All right, let's put this on log. Let's go here. Log. Oh, what's going on with this? Oh, here, let me get all this other stuff off of here. This does not want to be into logarithmic. There we go. So Bitcoin, log scale. Let's make it a line chart. Line chart. When the percentage of debt is increasing over the GDP, expect up. Expect up. And then when we're going into the refinancing periods of when it's more than other times. So, just go ahead and count 4 to 6 years. And it's a rolling thing, like year after year after year. So count 4 to 6 years from, when we have low inflation. All right. So let's zoom in. We have the weekly chart for Bitcoin. We bounced off of 54. We're in this range. This is a nice coil up, you guys. This is sitting on top of where we couldn't even hold our breath. This is sitting right on top of this price chunk, this area. It's forming a nice base and support, y'all. At some point, when everybody, we're talking about the US, the PBOC, we're talking about Japan, Europe, when they all say snap, okay, we gotta ease, because what's still happening is they're still tightening up on the balance sheet even though they're going lower on the interest rate, they're still not in quantitative easing. So in conjunction, when everybody's like, oh snap, everybody's in a standpoint to where it's like, yo, we got some issues. They got no choice. It's not so much like they make it seem it's about unemployment. Yeah, to a certain extent. But this is about, yo, we got to protect our butt. We can't keep letting this budget just keep killing us. We got to let it kill us for a certain period of time because we got to say we're doing our job. But ultimately, they cannot keep interest rates high, because high interest rates is what kicks their butt because they keep borrowing more than what they make. So the Fed is not a federal institution. They help the government keep going. And to keep going, you got to kick the can. So as we can see, it's been a nice expansion of, and now this is tracking all the countries, not just the United States, but yeah, China's going to lean into this. A little bit of Europe. It's going to lean into, hey, they got whole economies that they got to figure out where to place their excess liquidity or where to take it from when things get a little bit hard, where people have a little more fear. And so understand, this is why this stuff just keep going up. Now, crypto is going to be the most volatile, right? This is volatility, smaller asset. It's getting bigger. The volatility is going to dampen. This volatility is less than this volatility. But yeah, institutions want this stuff. They understand what's going on. Why? Because it got a cap supply. And so we've got to understand it's been an incredible journey from 2023 till now, right? Don't let this shake up define you and your portfolio like you didn't let this shake up define you and your portfolio. Same thing why you don't let this shake up define you and your portfolio. You just buy more lower. Because it's an aspect of understanding the demand for something when people realize that the returns are here, right? The S&P 500 is going to give you 10% annually. This is going to give you 40 to 50. And even over the next 10 years, maybe it drops down to 20%. That's still better than 10%, 2 times better. So, people are going to find a place that excess liquidity somewhere. And we just need Bitcoin to do its thing, because that's going to lean into these faster moving objects like Phantom, faster moving object due to increased liquidity. Boom. This is how we, like off these periods of where we've been buying for years since 2022. Just like, yeah, like to this date, we're still like 258%. That's better than 99.9% of the stock market. I don't care what type of volatility you sat through, right? And if you just hold on to this, once again, 4 or 6 years, understanding the biggest thing, what's going to be coming up, you're going to be happy. So investing, you got to understand, you got to be willing to stick with something for 10 years, yo. Like, yes, I understand if you bought it 2021. The key is, make it to 2030. And your whole opinion on how to be steadfast during a time of where you don't understand what's going on, you and me, it's up to us to understand these bigger levers to let us know that this chart is going to look the exact same through time, as long as this is a thing, has viability. And once again, that's why crypto is beautiful, because it's creating networks. Think about it. It's just a network where people are just sloshing around money, just like any other market. And that means there's value if there's a network, if there's people. One thing that I was thinking about, and I'll close on this. Some of the best companies are companies that don't actually necessarily create a thing, but they create the rails for people to get access to stuff. So, for example, you have Amazon. Yeah, they did books, but then they created the rails for suppliers to get their products to people. So they create the rails. Companies like Uber, they basically are the largest taxi company, but they don't have no taxis. They say, hey, people that need to make a little money, we'll give you an opportunity to drive for us under basically our rules, our regulations, our protocol. You can make a little something and help your neighbor down the street that needs to get from place A to place B. They created the network. It's valuable. Alibaba, right? Suppliers out in we're talking China say, hey, we got this stuff. We made it. We need to find a way to interact with people who might need the stuff that we make. Alibaba, hey, in the United States, hey, I want to go get these custom hats. All right. I normally can't talk to somebody in China just easy. They create those rails and the shipping and just be able to do all these things, right? So there's incredible value in creating networks. That's all crypto essentially is networks that involve gamification of money to a certain extent with whatever parameters and supply that is set from the creators of whatever coin and whatever network, whatever chain. So, yeah, Phantom looking good, y'all. Coming back up to local highs. I mean, I got on the chart, so might as well talk about it briefly. 75 cent, and we're talking about we're averaging buying this thing at like 30 cent, right? What happens in 4 to 6 years? It's gonna be some dollars as long as the network's still here. Hex coming up. Phew, nice recovery, 15 or 1.15 cents. Up big. We talked about the DCAs into the Pulse ecosystem. Did one live, here on the Patreon for those that are involved. I'm gonna go ahead and post this to YouTube as well. So yes, I'm not streaming every single day because what I've been believing in and I've been putting stuff in the Patreon every month, multiple things every month. But for those here on YouTube that are watching this is understanding that you need to not be focusing on the daily price action, because that messes your mind up. It really does. You need the mentality to understand, hey, what are the bigger levers going on that are moving things? How can I create more fiat to just get into the market? That should be your main focus and the main understanding that you have. And stop asking when we're going to keep going up. You need to protect yourself and your family by getting a financial backbone in savings. More than you worry about when is my 500, my 1,000, my 10,000, my $100,000 in crypto going up. Yes, its time will come, because time is the factor that no man can predict. But the key is understanding that there has to be forced movements at some point in time by these people that basically are playing the money game on the larger scale, which is the governments and the central banks. So, let's look at Total 3. Do your part, which is, like I said, making as much money as you can, creating new businesses, business ideas, revenue streams, whatever. And then getting that into the market that is going to be the most expansive, fastest horse, which is crypto. Let's look at Total 3. Total 3, since most of us have altcoins. And yeah, we talked about this, and there's important ratios to look at this, Total 3 over, other things to see how is this doing intrinsically. Whoops. Let's delete some of these things here. Get some clarity on the chart. Oops. All right. So, yeah, look at this. Boom. And it's starting to break out a little bit. 625 billion. So small. We're sitting here talking about how the government has overspent $1 trillion, almost $2 trillion in this 1 year. And this thing ain't even $1 trillion. It's like half of, or a third of what the deficit is just for the year 2024. This market is small. That means great opportunity. That's why it's so volatile. That's a beautiful thing when you think about it. But yeah, we're on of this price high to price low. We spent a lot of time on the bottom half. I generally, what I've said in the Patreon is like, if we find ourselves on the bottom half of price high to price low, from recent high to the market lows, so we had some opportunities here to beat DCA, and we pop back up above it, and there's going to be a time we'll play in this area, and there'll be a time that we outpace it. Same thing here. It's kind of like price high to price low, price high to price low. You're fine. DCA. So once you kind of really, it's very clear. Once you establish this, and you wait like 6 months after, like, okay, we see the high and low. Like, so all of this was like, oh my gosh, second chance. Yes. Beautiful opportunity. June of 19 to August. So like a year of DCAing into all your favorite alts. And the average thing is not trying to time it, switch from Bitcoin to your alts. So it's just like, just get into a horse that's going to be fast at some point that you know about, that has viability within the next 4 to 6 years to be still here. And we've talked about how to choose the right altcoins in the Patreon too. But thus, you're going to get the benefits. So you put some money from your check, and then let it go. It goes past the previous high. And then so, for example, how do we have that happen within a reasonable time frame? We're not talking about, having to wait till 2030. That's obviously the goal, to really see it through. For the average investor, you got to be able to learn to stomach the volatility. So if we just have a move like how we've seen here, which is nothing too crazy. So let's make sure we line that up. How we seen from October 2023 to basically March. So what are we talking? 6 months? A 6-month move. That would, once again, take us to a new high. Now, is it extremely higher, like from this last high, about 1 trillion, in a move like that will take us to 1.5? But yo, that's enough to get so many new people excited and into the market. And that's what sends your altcoin. Like we seen what Hex is doing 300% in 20 something days. You know, what Postchain could do, what Phantom could do, with all these altcoins that have people that take it serious. You know, people hate Hex, but people also take it very serious, a certain cohort. So if you have those dynamics in the emotional response of people understanding that, yo, just another, move like that, bring us to, you're talking 1.5 trillion. That's nice. That's how you get another 5x out of your altcoin from today's price, 7x. And if 5x to 7x, and here's what I've always said, if 5x to 7x, and I'm talking about the standpoints of even 4 years, 6 years, ain't enough for you, that means you just don't have enough money in the market. So the key thing is not worrying about, okay, which price don't you just need more money in the market while we have prices undervalued or valuations in market undervalued compared to what they're going to be due to the increase in new money in the system. Because let's talk about the trickle down of money, man. Because we need to understand how this works. Money gets created, right? It finds itself into the hands of big banks. Big banks and hedge funds get this money first. Then the first thing that they are going to do is invest a good portion, and then also collateralize another portion. So basically saying, okay, cool, we're going to take this. We're going to go ahead and collateralize it. We'll issue it to Joe who wants to buy a house. All right, Joe who wants to buy a house takes that, because it's the big banks don't get this new money at 0% interest rate. They get it at a better interest rate than what they're lending it to. So like they're getting a better interest rate than what they're giving it to for Joe. That spread, they're going to take that money, and that's how they make theirs. But understand, they just get a whole bunch of money very easily because it's being given to them with basically standards that make it hard for them, or I guess you can say easy for them, to mess it up. As long as they, do the right things. And banks have their own balance sheets that they have to keep, which they have hundreds of years of practice using us to make sure that they're good. Now, some banks get out of whack, but majority of them are protected because they can just keep getting more of this money to keep the system going. And yeah, hedge funds, banks get it. And then we start to see these assets like, oh, the institutions are here. What are they? Okay, institutions are coming. Institutions spend money. And then small businesses and large businesses borrow money from the banks. They go ahead and increase their productivity. They sell more goods. When they sell more goods, people see that. When they go ahead and do their earnings reports, that means people want to invest in the stock more. And obviously, when interest rates are going lower during this time as well, then, okay, cool. A person that could afford a $400,000 house can now afford a $700,000 house with the same down payment, same money, because they're doing it off of monthly interest payments. That fluctuates maybe a couple thousand, that now gets into that person's budget, that basically helps their debt to income ratio and things of what they can afford, all these different things. So economy spurs, assets go up, everybody's happy. And it's just a cycle of that and then tightening. Now we got to come back a little bit. Then we go back up. And that's why all these charts look like this. So understand the system, y'all. They're going to make more money. It's going to find its way to assets. This is an asset. The altcoins is an asset class. Crypto is an asset class where the money's going to be at some point in the future. So if you can understand that, That should settle you. And all you gotta say is, I just gotta chill and not mess it up for myself. And the people that mess it up for themselves are all these people. People that mess it up for themselves are all these people. All those guys. You messing it up for yourself because you don't understand the game. I mean, let's extrapolate that even more outside of crypto. Let's go to NASDAQ. We haven't looked at that chart yet. People that mess it up for themselves because they don't understand. All these people. All these people. When you realize you can be in forever profit if you have patience to wait long enough. 10, 15, 20 years. Forever profit is a beautiful thing. Because once you have an asset that you can just, piece a little bit off of, and ideally this asset is going up faster than the things that you want, the prices of the goods and the services that you want as a consumer, then that means as you piece off a little bit every year or when you need it, you're perpetually going to continue to increase your purchasing power because this outpaces what you want. This is the key. The NASDAQ and crypto are the only things that do that. So, I mean, yeah, these people messing up. So, stay in the game. Chill out. Keep putting money in. That's how it works. Remember, 87% of the time, these markets are going up. 13% of the time it's going down. That should tell you all you need to know. Look at this. Look at this. Wee, 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 wee. Yes, it's a scary. Oh no. Yay. Oh no. Yeah. But just look at the overall trend. And if you just want to say, because you have to invest through a lifetime, there's no other option, or you're going to get chopped up by the frivolousness of the economy. That's just how it works now. So if you don't understand this factor, hopefully now you do. And hopefully you want to do something about it for yourself and your family. That is the trend, you guys. That's the trend. Channel. Well, we've gotten back on the upper half, which is nice. Let's keep on rocking. So that's just the NASDAQ. All right, y'all. So I've been long at the tooth. I mean, I could do this all day, but I think I'll stop the video here. Ethereum at 26.13. This is a buy because the BTC to Ethereum ratio is at a low point. And once you get to these points, there's going to be a time where Ethereum's going to slingshot past Bitcoin during a certain duration. You want to be in the asset before that happens. And so that's probably coming up here within the next 12 months or so. So yeah, once again, Ethereum looking good too. Chilling at these upper bounds. And yeah, we'll get some more money coming in here over the next 4 to 6 years for sure. Cool. All right, man. I hope y'all are doing well. Yes, I've been out, but I'm always going to just only give value because that's the only thing that matters when it comes to information. Y'all be good. I will catch you guys in the next video. All right. Peace.